In this video, we're going to talk about position sizing and risk management when investing in stocks. And we're going to use an example problem to illustrate this. So number one, Rachel and Tim each have a trading account balance of $50,000. Rachel buys 25 shares of stock XYZ, which is currently trading at $10. Tim buys 1,000 shares at this price. And now the stock begins to fall. Part A, which individual will be more susceptible to fear? To help answer this question, calculate the percentage of their trading account balance that each individual is willing to risk. So if you want to pause the video and you want to try it, feel free to go ahead and do that. First, let's find out how much each individual is willing to risk in this trade. So I'm going to put Rachel on the left and then Tim on the right. So Rachel buys 25 shares of the stock, which is currently going for $10. So her investment is $250 in this company. Tim, he buys 1,000 shares at $10. So his total investment in this company is $10,000. So Tim can make a lot more money if the stock moves in his favor, but he can also lose more money if it doesn't move in his favor. Now let's calculate how much each individual is willing to risk relative to their trading account. So Rachel is willing to risk $250 and her trading account is worth $50,000. So if we multiply this by 100%, we can see the percentage of her trading account that she's willing to risk on this trade. 250 divided by 50,000, that is 5 times 10 to the minus 3. Multiply that by 100. So she's only risking 0.5% of her trading account. Tim, on the other hand, he put 10,000 into this trade and he only has 50,000 in his trading account. 10,000 divided by 50,000 is 0.20 times 100%. So he's risking 20% of his total trading account on this trade. So Tim can't afford to lose on this trade. If he does, it's going to cost him a lot. So therefore, fear will affect Tim a lot more than Rachel. If Rachel loses her entire investment, it's not the end of the world. She's not going to lose sleep over it. So therefore, fear is not going to affect her as much. But Tim, if he loses his entire investment, that is really going to put a dent in his trading account. So therefore, his decisions will be more susceptible to fear. And that's one of the important things of position sizing and risk management is if you limit the amount that you invest in, if you invest only in the amount that you can afford to lose, fear doesn't affect you as much. If you listen to many stock traders and investors, typically they'll say with regard to position sizing and risk management that it's never wise to invest more than 1 or 2% of your trading account balance so that you don't get wiped out, because mistakes will be made, but the important thing is to learn from those mistakes. Now, for those of you who want to learn how to find stocks that are going up, I've posted a video on my Patreon page, and here is the link. It's a very brief video. It's very straight to the point, and it quickly shows you how to find stocks that are going up. So feel free to take a look at that when you get a chance, and let's get back to the video. Now, let's move on with this problem. Part B. As the stock continues to fall to $4, Tim cashes out to prevent any further loss, but Rachel buys 100 more shares at this price. Eventually, the stock rebounds and rallies to $20. Calculate Rachel's ROI if she sells all her shares at $20. So let's say if we were to draw a graph. Here the price is at $10 and then it craters to $4. Now, if you're Tim, you might be concerned about this because you've invested a lot of money at this point, and seeing the price go down, you don't want to lose any more money. So do you think it was a wise decision for Tim to sell his shares at $4, taking a big loss? Well, it really depends, because he needs to ask himself, why is the price of the stock going down? Is the company going bankrupt? Is the market in a recession? Will the company rebound? So there's a lot of factors involved here, but we'll keep this example problem simple. We'll focus on the math. So let's say the company is not going bankrupt. It's a decent company, but because of fear of losing more money, he cashes out. And Rachel decides to buy at 4. So first, let's get rid of this. Let's calculate Rachel's total cost of investment. So she put 250 in the first trade, and in the second trade, she bought 100 shares at $4, which means she's invested 400. Her ROI is going to be the profit or the gain that she realizes when she sells her shares divided by her total cost of investment times 100%. So now let's calculate how much profit she's going to generate if she sells all her shares at $20. First, we need to know how many shares she owns. So she bought 25 shares on the first trade and bought 100 shares on the second trade. So she owns 125 shares. So if we take 125 shares and the fact that she's selling it at $20, that means she's going to receive $2,500 when she cashes out. And then we could subtract the $250 that she paid for the first 25 shares and then subtract it by 400, which she paid for the 100 shares that she bought at $4. So her profit or her net gain is $1,850. So now to calculate her ROI, it's going to be the profit of $1,850 divided by the total cost of investment, which is $250 plus 400. So she invested a total of $650 in these two trades times 100%. So her return on investment is 284.6% if you round it, which is pretty good. Now granted, the company could have gone bankrupt, and on the flip side, the most that she could lose would be $650 if the company went bankrupt. Now let's calculate Tim's ROI. So as was mentioned before, his total investment is $10,000. Now he's going to sell it at $4, all his 1,000 shares. So he's going to receive $4,000 when he sells those shares, but he put in $10,000. So his trading account balance went down by $10,000 when he bought the shares, but went up by $4,000 when he sold it. So he's looking at a net loss of $6,000. So that is his profit on this trade? Negative 6,000 divided by 10,000 times 100%. So his ROI in this example is negative 60%. In terms of magnitude, that doesn't look as great as this one, but in terms of value, that's a huge loss. So because he risks so much in his trade, if the trade goes bad, he's looking at a big loss. And not only that though, but if the company goes bankrupt, he can lose $10,000, whereas the most that Rachel could lose is $650. So in this trade, so let's think about this. If the trade went well, if it rebounded, Rachel's looking at a profit of $1,850, whereas Tim is looking at a loss of $6,000. If the company went bankrupt, Rachel will only lose $650, whereas Tim would lose $10,000. In both cases, whether the company rebounded or whether the company went bankrupt, Tim is still looking at a loss. Whereas Rachel, she's looking at a good win if it rebounded, but only a small loss if the company went bankrupt. So in either case, Rachel made a better decision than Tim by investing in small amounts. So looking at part D, how important do you think is position sizing and risk management when investing in stocks? So we could see that for one thing, when your position size is 1% or less than your trading account balance, fear doesn't affect your decision-making process as much compared to if you're risking 10 or 20% of your trading account balance. So that's one advantage. Two is you limit the amount that you can risk on one particular trade. As we saw in this example, if things go bad, Rachel will only lose $650, whereas Tim, he stands to lose up to $10,000. So risk management and position sizing, they could limit your losses if you employ those factors or those things if you employ those concepts when investing in stocks. So that's it for this video. Hopefully you found it to be educational. So thanks for watching.